Hi, Dr. Dolly. I had a question about when to add new asset classes to your investment plan. So, on one end of the spectrum, you've got equities, bonds, and broadly diversified index funds. On the other end of the spectrum, you've got Bitcoin and tulips. And in the middle, there are some emerging asset classes that perhaps historically didn't exist. So, at some point, crowdsourced real estate, for example, came into being. And there's got to be some sort of litmus test that can be applied to determine whether a new asset class that has not historically been part of your investment plan is a reasonable addition. So, how do you assess something like that and determine whether it is too speculative or whether it really deserves to be in your written investment plan or not?
Okay, this is a great question. Surprisingly sophisticated question, actually. This is an issue most people who put together a written investment plan will run into at some point or other. For example, Katie and I put our written investment plan together in 2004, 2005, right? There were a lot of things that were not available, didn't exist in 2004, 2005. And your investment plan, this written investment plan that I hope you all have, is a living, breathing document. It's like the Constitution, right? It can be amended. And so you want to be able to amend it, but not make it easy to amend it, right? What's it take to get a constitutional amendment? Well, basically, you got to get it through these super majorities in the House and Senate, and I think 75% of states have to approve it. So it's not an easy process. And that's the way it ought to be to amend your written investment plan. It shouldn't be an easy process. For example, in ours, we said we're not going to make any changes until after a 3-month waiting period. And the goal for that was to keep us from chasing some hot asset class or doing something stupid we would later regret. But we did make provisions that if something changed and we wanted to add another asset class, we could make those changes. And so from time to time over the last 16 years, we have occasionally made a little change in our asset allocation. For example, when Vanguard came out with the small international index fund, stock index fund, we wanted to add that to our portfolio. And so we did. We added it as 5% of our portfolio. And we added that in. I took it from the total international stock allocation, carved it out of that, and put it into the small international index fund. And so that was something that we saw going forward that we wanted to do. And so we did it. So what criteria should you use there? Well, asset classes you want to add to your portfolio generally should have some sort of positive real return, right? You want something that's actually going to make money at a rate higher than inflation over the course of your lifetime, right? So that's what I look for. I want it to have a positive return. I want it to have less than 100% correlation with something else in my portfolio. The lower, the better, right? I mean, ideally, everything's completely uncorrelated, but that's not always the case. You know, most stocks are at least somewhat correlated with each other, but low correlation is also good. You want to be able to diversify the investment. You know, if there's a great index fund out there for this asset class, that makes it really easy to diversify that particular asset class. If there's not, well, you got to think, is there some other way I can diversify it? And if there is, great. If there isn't, maybe you should skip that asset class. But I also look for asset classes that are real investments. Okay? And when I say real investment, I generally mean that it's either a productive asset, meaning something that produces something like earnings or rents. You know, we're talking about real estate, we're talking about stocks, we're talking about small business, that sort of a stuff. Or it's an interest bearing instrument. You know, it's a CD, it's it's a real estate backed loan, it's those sorts of things. It's a bond that will actually produce some interest. I tend to stay away from speculative investments, things like gold and silver, currencies, cryptocurrencies, oil, and other commodities. I generally don't put those into my portfolio. That doesn't mean you can't do it. If you want to hedge your bets and put 5% of your portfolio into oil or gold or Bitcoin or something like that, that's not crazy to do, right? Don't put 50% of your portfolio into it. That would be not reasonable. But if you want to put a little bit of your portfolio into it, that's okay. But I would encourage you to give it a waiting period and make sure that you can invest in it in a diversified, relatively low-cost way, in a reasonably liquid way, in order to do those sorts of investments. And then as these new asset classes come into being, you got to look at each one and say, does that have a place in my portfolio? And really watch yourself, because what often happens is people get this fear of missing out and they start performance chasing, and that's usually a recipe for underperformance, especially in the long run. So I hope that's helpful. All right, let's take a look at the quote of the day today. This comes from Sunny Sakar, who said, "Do not mistake simple index fund portfolios as simplistic. They're actually quite sophisticated, standing on the shoulders of decades of peer-reviewed market research, a few Nobel Prizes, and cold, hard, undeniable evidence of success." I think there's a lot of truth to that. I've been accused by bloggers or whoever out there of not being sophisticated, because I don't have some complicated investment scheme. I don't get involved in a bunch of this cash value life insurance where you're putting money into the policy and borrowing it out. I'm not sophisticated enough. Well, it certainly worked. Right? What I did worked. It's not complicated. It's pretty simple. I funded it adequately. I stayed the course with it. I kept my costs down. And you know what? Here I am in my mid-40s. I can do whatever I want with my life. I have all the money I'm ever going to need. So it certainly works. And that is the case for the vast majority of physicians and dentists out there. If you will pick a reasonable, straightforward, simple investment plan that you can teach to your fourth grader, and you can follow it, and you fund it adequately, it's going to get you to all of your reasonable financial goals. Now, is it going to get you to a $100 million portfolio? Probably not. You're going to need to own a successful business if you want to get there, or get very lucky speculating. But it will certainly get you to a place where the vast, vast majority of people that have ever lived on this planet would love to have gotten to, which is being a multimillionaire, being financially independent by mid to 2/3 of the way through your career, and being able to have a great financial life without worrying about money. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA, or click the link in the description.